Hi, everyone, and welcome to the webinar today. It's the Building Wealth for Your Kids webinar. And we've got a funny little tagline there, which is, I guess, outsource their future panic to your present self. I'm Tom Wilson. I'm the investor educator at InvestSmart, and I'm joined by my friend, my colleague, and devoted mother, Phoebe Kohler. Hi, Phoebe. How are you doing?
G'day, Tom. Thanks for having me along. It's good to be here.
Thank you so much for coming, because we definitely need your expertise, particularly in the parents department. I'm not a parent myself. However, I definitely have got nieces and nephews who I invest for, but it'd be good to get a bit more of an insight into what you think. I'll just run through some introductory slides for you here. And basically, welcome for coming and showing up. You're actually making a really good move by doing this. We're going to put the slides up on the website, and I'll put them up on the events page up on the website there, which is, I'll just see if I can find it. You can just go to investsmart.com.au/events, but that's the full name there. But if you've got questions, definitely pop them in as we go, but we've got a dedicated question and answer part at the end.
Absolutely.
And also, I'll just quickly read out this important disclaimer. So we provide general product advice only. We don't provide any personal financial advice, and we're not tax agents. We're not tax advisors. So we'll be referring to the ATO's website around taxation. And all that is current as of today, the 29th of May, 2025. So it may change even when we finish this webinar. They might suddenly improve it and make it easier for everyone. I wish, but let's see what happens. Obviously, it's a very straightforward thing about why would you want to invest for a child. Your future 18-year-old is not going to really probably thank you in words or probably in emojis, and there's some examples. But Phoebe, you've got a really interesting story as well as to why.
Yeah, look, I've been thinking about it, right? So we've got a 4-year-old, and I've been thinking about how to help her in the future. And I was talking to a friend of mine who told me this story about how when she was 10, her dad said to her, would you like to have some shares for your birthday, or would you like to have a bike? And this friend of mine said to her dad, hey, I don't, what are shares? And her dad said, well, you're not going to see them, right? So you're not going to know they're there, but it's money, long-term money. And of course, my friend said, I want to have a bike, Dad. So she did, and look, I thought about it, and I'm doing some calculations, and I found out that in 1993, which was when my mates are all around the early 40s, so 10 in 1993 cost about $500 for a bike. If that $500 was invested and was contributed to $50 each week, using our high growth portfolio as an example, which since inception is 8.35%. Compounded at 25 in 2008, would have been handed over 80 grand. So it's powerful, bike. Right? It's powerful. It's an expensive bike.
Yeah, in hindsight.
Yeah, that's right. I'd say the bike's in landfill now,
It's difficult, isn't it? Because I know even my grandma, she would say to me, just put, $1 away a day and it'll be worth this much in the future. And I didn't start doing that until I was much older. But
well, neither did I. No.
Old head, young shoulders. Hopefully, though, correct, the people that are watching this video, this webinar, they're actually attending. That's a really good sign that you're going to start actually doing something about it. So, your child, or it's not just you might be a grandparent, you might be an uncle, you might be a family friend. This webinar is for you. So we'll go through and try and help you as much as we can. We don't need to sit here and really talk about this slide too much, but obviously if you delay it, the less time that investment gets to compound, because remember that the compounding part is the magic, really. It's just basically showing, and I'll just make it slightly bigger, that if you were to start, not on the day of birth, obviously that'd be very difficult, but it says starting from birth, if you're adding $50 a week, you can actually grow it into $84,000 by the time the child's 18. And when you sort of wait, until they're 5 years old, you lose effectively $25,000 of the final total And if you even wait years, it's obviously more. And half of the final balance that you end up with there is actually from compounding, not really from the contributions side of things. So what we're going to do is we're going to tackle into some of the most commonly asked questions. And the other thing too is that this webinar is actually part of an ebook that we put forward, and it's free to download. And I'll just bring up the website, but I will have a link later on when I show you. If you go to investmart.com.au/guides, our teams put together a free ebook, and it goes through a lot of what I'm saying in more detail. You can also get these slides at the end as well, because some of the stuff I'm trying to show here is a bit small. So, I mean, I'm sure you get this, Phoebe. People, when you speak to clients, they're asking, how should I set up a legal structure, or, where should the money, essentially?
Absolutely right. It's by far the biggest thing to consider, really. And I could use a bit of guidance myself, to be honest, Tom, so let's get into it.
Yeah, well, you can see here there's numerous pros and cons, and I've got 3 different ways in which people tend to set up a structure. One of the easiest, the very first ones, is in your name, or obviously you can usually do a joint. So it might be, say, you and your husband could do that. That's very easy to set up. You've got full control over the funds. However, the income that's paid out by the investment, it actually is taxed at the adult rate. So if you've got someone who might have a lower tax rate, and you think, done all your research, you've done your forward planning, it might be beneficial, but again, it's good to get advice on. So some of the negatives, though, obviously, is that the investment, if it's in your name, you legally own that investment, and it's not the child who owns it. So when you transfer it to them in the future, unless they change some laws until then, based on today's laws, you'll actually be paying capital gains tax to transfer it. So it triggers a CGT event, and it can also complicate estate planning if it's not included in your will. So we'll go to the
point.
Yeah, we don't often think about the actual will side of things, about who we leave it to and everything like that. You've got to be very specific, because otherwise it might just go, if you haven't updated your will, particularly after you've had your child, it might go to, Auntie May, your sister, who you don't speak to, but well, not your sister, Phoebe, but we know your sister. But if we look at the extreme
you never know
end
what's
again,
going to happen, hey?
That's exactly right, and that's why the whole thing's about planning. So the extreme version of planning is obviously the formal trust, and that's usually you'll go and see a tax accountant, a lawyer. There are online versions now, but you're setting up a legal document, a legal entity, so to speak. And with a formal trust, you'll have the trustee, could be, a group of people, it could be a company even, and it's a very long-term structure. It's got flexible income. That's why they call it discretionary in some cases. You've got discretion over what percentage you want to pay to a certain person. The thing is, though, it's flexible once the child's 18. So if you've got children in there who are all under the age of 18, you'll actually be paying penalty interest. Penalty tax rate, which we'll go through later. I'll show you how much the tax is if you decided to actually let your child be the taxpayer. The other thing too is if you don't distribute any tax, it gets left in there. It'll actually get taxed, I think, at a base of around about 30% from memory. So you'll be paying tax on it if you don't distribute it to any beneficiaries. You've also got to get it, the tax returns have to be done every single year, and you've got to submit a tax return. I hate doing my tax, so doing it for the actual trust.
Yeah, and these trusts, they need to be audited every year. Is that right?
I don't think they do. I think it's more of the super funds. If you go to SMSF, that's something that gets audited. But with these, you'll usually have to take it, unless you know what you're doing, take it to an accountant to sit there and go through and do it for you. And the other thing is so it's more tax effective if you're actually distributing income to adults. So it sort of defeats the purpose in the sense of for children. But the thing is, obviously get advice, and if you think it works for you, particularly for large amounts, it might be helpful. Straight down the line, there's a thing that's called informal trusts. Now, InvestSmart, we actually offer these. We call them kids accounts, investing for kids. And it's usually an adult as the informal trustee. And the actual account says, say, you know, Jane Citizen Senior in trust for Jane Citizen Junior, the child. So it's not actually a legal, it doesn't actually have any kind of legal weighting to it. They're fairly straightforward to set up in terms of through companies like InvestSmart. You just literally choose that and enter in the details. There are ways that you can then, when the child becomes 18, you can transfer that investment onto the child without triggering the capital gains tax, but it's very complex, it's very murky, and even the ATO themselves, they say that. They give some examples on their website, and I'll give you the link for that on an upcoming page. But as you can hopefully see here, it says the ATO looks closely at who provided the funds and who benefits. If the child isn't the true owner, the income gets taxed at the parent's rate. If the child is the owner, there's the, they call it minor penalty tax rates. They might apply, and I'll show you these. You might also require TFN for the child and the annual tax returns.
It's also important to note, I think, that there's no big bell that rings when the kid turns 18. You don't need to transfer the units when the kid turns 18. You can wait until whenever suits you as well. That's correct, isn't it?
Yeah, I mean, I know with our accounts for children, that's the case, where you might wait until the child's like 20 years old, for example, and then you'll look to transfer it across. The other thing I know that you get asked about a lot, Phoebe, is the tax file numbers. Obviously, if you're doing it with a formal trust, you'll use the trust's TFN, and it's the taxpayer. If you're doing it in your own name, obviously the adult, the parent, the mum, dad, they're the taxpayer. If you decide to get a tax file number for your baby, your child, you can do that, and you can then give it to the investment company, say InvestSmart. But obviously you've got to watch out for that penalty tax that gets charged. And I'll go through that, like I said. But if you decide not to give a TFN, well, then there's a withholding tax. So they basically withhold at the top marginal rate anyway. So it can be tricky. That's why it's good to plan this out. What I'll quickly just show you is, I won't talk about this too much because it's something that is just saying that, you know, obviously tax is boring, expensive to ignore. There's a link actually here. Take our faces off. You can see the link there. That takes you to the actual place talking about share investments, for example, and how the ATO views that. But what I'll quickly do is I'm going to just quickly, you know, 3 ways you can avoid the tax surprises is obviously having the right structure. So what we spoke about before, consider growth investments. Now, this is very important because I'm not saying to you, go ahead and just go into a growth type portfolio or high growth. I don't mean that whatsoever. I mean that consider them in the sense that if you want some kind of investment that's really going to just go up, hopefully more in capital growth, capital gain, it probably won't pay too much income as it goes. That's why you might consider something like that. That being said, we're going to run through some investments as well, and you can have a look and see how they work. Ultimately, consult a tax advisor. If there's something that you're thinking, oh, I'm not sure about this, they can give you detailed advice that's up to date through their framework. So here's the tax rates if you're under 18. And to be honest, when I saw these just recently again, I was getting a bit surprised about how expensive and how high they are. And obviously the ATO is setting this up because, I mean, I remember hearing of stories where a lot of parents had different trusts and they would split it all to different kids. And they'd be essentially minimizing their tax through a legal thing. But it meant that ultimately there wasn't much tax getting paid. So with this example, with these tax rates, the ATO, I guess the government's trying to stop that from happening. But let's have a quick look, because you might see here, and there's also the link there showing you, but it's saying that from $0 to $416 in that bracket, the child pays nil. And then from the next bracket, which is $417 up to $1,307, they'll still pay the nil in that first part, but they'll pay 66% in this bracket. So 66% of income will go to the ATO.
That seems pretty high.
It is very high, isn't it? It's higher than the highest marginal tax rate. And then anything, if it's over 1,307, 45% of the total amount of the income that's paid to the child, that's not accepted income. Now, this is where the common sense part kicks in. And this is for a resident as well as other, obviously, non-resident rates. But if the child is obviously working themselves, working at Pizza Hut, Domino's, that's an accepted income. Or if they've got a disability and obviously the money is being used to help them, obviously, that would be accepted. But this is the whole idea that, let's say that if you didn't know this and you decided to put down your child's tax file number and you invested in something that pays a lot of income over 10, 20 years, a lot of it could go to the tax office. This is a lot of information. I put it here just so we can look at it after, because I've made a flow chart, and this might help explain.
This is helpful, this one.
Yeah, we did run through this before, didn't we?
I like it. We did.
The ATO looks at 3 different things, and they say who provided the money. And if it's the parent, which probably is going to be the case in most cases, or if it's even like an adult, then they say, well, who controls the investment? So if you open something up, you choose what to invest in, you've got control over whether you want to close the investment, redirect the income, all that kind of stuff, then they would say you control it, and you technically use the income, and it'd be taxed in the parent's name. If the child controls the investment or uses the income, you can see that little warning sign there that the ATO still might consider that. They would probably challenge it, and they'd still say that's in the parent's name. But if we looked at the other way, the child, they're the one who provided the money. So maybe they saved up from working at Domino's, JB Hi-Fi, and they decided to invest it. That would be who uses the income. If they use it themselves, then it would be taxed in the child's name. So it would be those minor tax rates. But if it's used by the parent, which can happen, the parent might say, I remember my mum was raiding, well, not raiding, but she used to help. She used to ask for some of the Dolomites account money back. Dolomites at Combank. But in this example, if the parent is saying, well, you put that away, I'm going to start using some of the income just to pay for,
school socks.
Couch. Yeah, or, it might be considered that the parent's using it and it's taxed in the parent's name. So this is why it can be quite tricky. And this is why I would definitely recommend going to the ATO website. They've got examples up there, but also speaking to someone who is an expert in tax, in terms of they can give you the right guidance in case you're not too sure. Let's get to the fun stuff though. Tax is obviously not that fun, but there's 4 investment options that we cover off in the ebook, and we'll run through them quickly here. And most people know about shares. It's like the do-it-yourself garage project. That's fun, fiddly, rewarding if you like the tinkering, and you've got the higher return potential, but the higher risk as well. ETFs, we like to call them, it's like the IKEA flat pack of investing. They're ready-made, off the shelf, solid, surprisingly good looking. Well, some IKEA stuff. It's some one-click diversification with low fees. There's the micro investing apps, companies obviously like Raise, etc. And we like to consider them as being like the training wheels for the investing bike.
Yeah, I think they're good to get going. I mean, I know it's hard to scrounge up a big chunk of cash to invest, and it's nice to get the ball rolling in a small way down a long hill.
That's a good point.
And turn it into a bigger investment. Turn it into a,
That's right. Yeah. And the thing is, in the ebook, we do use an example of $50 a week to get to that 84,000. And that might be one way that you could look at it. The other thing too, which not many people know about, they sort of sit on the fringe a little bit, and they're called investment bonds. And they're usually within like a life insurance setup. And I'll cover them in detail, but I like to refer them as the slow cooker. It's like a set, forget, wait for a very specific dinner party. So let's have a quick look at the shares. With shares, usually you might look at the growth mix just because it's more focused on trying to increase the value of the holdings. It does obviously generate some income, but if you're looking very long-term, that's something that you might want to consider. Usually you can buy through an investor like ComSec, even Stake nowadays. They usually let you invest in parcels of $500. There's the DRP, which stands for Dividend Reinvestment Plan. So you can turn that on, and any income or dividends that those shares pay can get invested back into that, so they can buy more of those shares. One thing a lot of people don't realize is that even though you're investing it back into those shares, you might think, well, I'm not receiving the income. The ATO says, no, you actually are receiving the income and you're buying new shares. So it will count as income.
Good to know.
And then the investor discipline part there, it requires discipline. I mean, you want to also be diversified. You don't want to just go out and just buy Qantas or just buy, NAB or something. You want to make sure that you are fairly diversified. And to be honest, active investing is quite difficult. Trying to beat the market, it's something that even professional fund managers don't do. But that being said, we'll go on to one of the next best things, which is the ETFs, exchange traded funds. And there's over 370 ETFs just on the ASX. So you can actually buy them through a share brokerage company as well. So there's a big range to choose from. They all do different things. On our website, we've actually got an ETF filter tool, which is a free tool to use. They usually have low fees because they're doing them on such a big scale, big companies like BlackRock, Vanguard, VanEck, BetaShares. The instant diversification is really handy because once you buy a diversified ETF, it's like an off-the-shelf option essentially. That being said, let's say you were to buy the iShares IOZ 200, which is the top 200 Aussie shares. It's only diversified within that asset class, which would be Australian equities, not everything, which is what you should do.
Yeah.
Index performance, index returns beat most active managers. So Warren Buffett famously was saying that, when he was going to pass away, he said to his wife, just pop it all into an index tracking fund. Don't try and beat the market. And that holds true pretty much for most people. The micro investing, apps like Raise, and you made a good point, Phoebe, about it's a good way to start at the start. And there's also other things that the ebook talks about in terms of it's a behavioral nudge, but that's the low entry point. It's fairly straightforward, like it rounds up and just does it automatically. One of the biggest disadvantages is, though, if you were to look at the actual fees that get charged on the minimum starting balances, they actually can be very high.
Yeah, they really can.
And they usually are an indirect ownership structure. It's usually like a custodian type approach where all your shares are bundled into the same account and you own a percentage of that. You don't own your actual physical ETF or shares.
Good thing to know.
This is something that we'll cover off, and the ebook that I'm talking about has much more info about this. And it's something that I definitely learned more about in this whole process. But investment bonds, the slow cooker of investing, set it, forget it, check back in 10 years. So they use it as an insurance wrapped investment. And these aren't government bonds. They're actually tax paid investments that are inside life insurance structures. It's a bit of a mouthful, but that's the way they are specifically created in order to do what they are trying to do. So we'll look at the contribution limits, because obviously you want to contribute to your investment. That makes it grow faster. That makes it compound, reaching the goal. They've got this thing called 125% rule. And it means that except for the first year, every year after that, you're only allowed to invest 125% of the year before. So let's just say that if in the second year you invested 140%, they actually say that the 10-year period, it resets back to that year. And the 10-year clock is important because this is what these investment bonds do. They actually are taxed internally at 30%, and whoever manages it for you is paying that tax. So you do pay tax, of course, but the withdrawals then become tax-free after the 10 years. So when they let you take the money out and you've done the 10 years of the investment time.
Do you have to be on top of that 125% rule? Do you have to know how much to contribute, or is it something that's told to you?
You'd be hoping that whoever's offering that to you would give you some guidance, but there may be cases, depending on whoever the provider is, because there's so many different types. I think Vanguard even offers some. They're very bespoke. They're quite specialized type products. So again, do your research. Because there's nothing worse where if you aren't keeping track of it and you do go ahead and put in more than that 125, that would reset it, which could blow up the plan.
That's right.
These are really good for parents in the higher tax brackets, it says there, and also for planning ahead. It's a very long-term strategy. It's something that you've got to be very careful about because you've got that 10-year rule. It's not really a set and forget for the pocket money. And they can have higher fees. They can be inflexible in the sense of if you need the money after a certain point, or if you accidentally put too much in because you've got, say, a windfall, you have to be very careful about putting it into the investment bond. Pretty much, I like to wrap it up and say you wouldn't use a slow cooker if you wanted a dinner in 10 minutes. But if you're planning ahead, that could be your financial lasagna.
Slow cookers can be great. Yeah.
They can be. But let's bring it back away from food to a real life story. And Phoebe, I know that you were telling me you and your husband were considering investing for your daughter.
Yes. Sort of getting back to that story about my friend, and that sort of, you don't want to call it a missed opportunity, right? But we, as parents of young children, have this opportunity now to give her a chunk of money when she turns 20 or 25, because we have this really long run up. And, as they say, it's a bit of an adage, but time is the biggest asset when it comes to investing. So what I'm thinking of doing is scrounging up the $10,000 and then potentially adding $50 a week to that across a 20-year period. I want to, we obviously, because it's such a long-term proposition, probably high growth for us is right. And I really like the idea of setting and forgetting. I think it's kind of important in a way. I don't think we would miss $50 a week. And that, for us, $50 a week, I don't think we'd miss. Maybe we will. I don't know. We'll have to reassess, right? But even if it's 25, that would be great. So what would that get us in the end, do you reckon? I think using a compounding calculator gets us around $170,000 by the time she's 25.
That's a pretty good.
So I think that's pretty good.
Yeah, a present. Because I remember you were saying that you also want that set and forget's a good idea, of course, but you want the tax statement sent to you, and you also, let's say if something happened.
Well, just the thing is, right? So when you've got young kids, life's really busy. You don't have a lot of. I personally don't have a lot of time to think about admin, to think about. I'm not very good at paying bills, to be honest. I could be bothered finding the I shouldn't say that, but actually making the transaction can be something that you've got to find time for. So if it's a set and forget setup, then I personally am much more likely for it to continue and to be successful.
That's exactly right. It's that automation that we find is one of the ingredients, again, when it comes to investing, not just for kids, but for everyone, get that behavioral habit built
Yeah,
up.
that's right. I also would like our kid Rosie to get to know that this money is there for her, and teaching her about financial literacy, so that it wasn't, you know, that it did take a long time to get, that it is not nothing, and but that the money that we will hopefully be able to provide for her in her early adulthood will give her a real boost in choosing what she wants to do, whether that's education or buying a house or whatever it might be. Hopefully she uses it well. And hopefully we can instill that in her. But yeah, look, I'm very excited about it, actually. Maybe we can do another webinar where we go through the application process. What do you reckon?
I think it's a good idea. And obviously, we're talking about application process, talking about our in-house products at InvestSmart. It's something that I'll run through even quickly and just talk to you about. So we've spoken about, obviously, how there's different ways to go about investing, but there's also the InvestSmart way. And what we do, we try and make it really easy. We try and keep the fees down. And what we offer is basically 6 different diversified portfolios that someone can invest in. And instead of me talking about it, what I might quickly do is I might just show you on the website here. So I'll just put my face down the side. Good plan. Yeah. So basically with this, it means that if you come along, you can see the diversified portfolios, and this is on the Invest With Us page, and I'll put the link up for you. But what we do is you can choose a diversified portfolio. So the money gets split across, I think it's 5 different asset classes. And you can see conservative, balanced, growth, high growth, the different performance that it offers. So I know you were talking about high growth in Phoebe.
That's what I'm looking at.
There's also 2 different ethical versions. There's an ethical growth and an ethical high growth. What we'll do is I'm going to click on learn more just to show you what I'm talking about. So you can see here that the total return, and when we say total return, it's the income, the dividends, and also the interest that's generated, plus the capital growth. So we have it in fairly straightforward terms, and we've got, let's have a look. So since inception, it's given on average each year about 8.34%. Comparing that to our peers, so people who are, well, companies that are doing the same type of investment, they get about 6.10. So for us, the excess is 2.24% per year. And the reason why we do that is because we cap our fees. We have a low fee, which is 0.44% per annum on balances up to 200,000. And if you've got more than 200,000, that management fee, it hits a ceiling and it's capped at $880 per year. So it doesn't get bigger. There's a 0.11% per annum admin fee, but we actually pay for all the buy-side brokerage. So when you invest, when you put more money in, instead of you being charged brokerage to do that, InvestSmart covers that. So it's $0 buy-side brokerage. There's none of that. There's no performance fees either. And the reality is that's because also it's designed to get the market returns. It's not trying to beat the market. It's doing, like, I guess, the Warren Buffett to his wife approach, saying, don't try and beat the market, just follow it. So what we do is we invest in different ETFs, exchange traded funds. So instead of you doing it yourself, we've got a collection of doing it. And this is the graph that's just showing how we outperform our peers because probably of the fee structure that we've got. And that's going to get wider and wider as the years go on. We don't hide anything. We're very transparent. You can actually see the asset allocation and the holdings here. So you can see that we follow the diversified approach, and this is a high growth. So as you'd be guessing in the name, it's very growth centered. It's going to put money into investments that are going to increase in value. They'll pay some income out, and there'll actually be fixed interest here, which invests in bonds, but you can see the percentages, and we show you exactly what we purchase. So we set up a brokerage account, and we purchase those ETFs, you can copy this if you want. But if you want us to do it for you, rebalance it as well in case they get out of whack or when you add money, that's what we do at InvestSmart. The other thing is too, and there are some slides explaining this, but we do offer these with the fund later. And fund later is a novel way that we've invented where if you don't have the 10,000 minimum to start one of these accounts, you can actually come to us with at least 4,000, and then you've got 20 months and you can make a $320 repayment for each of those months. Sorry, 325, isn't it? 325?
325, yeah. That's the minimum. So you can choose to contribute a little bit more and pay it down faster, but minimum of 325 per month across 20 months.
And what that means is that you get invested immediately. You don't actually have to wait until you've saved up the 10,000, and you get invested immediately. You start paying that 325 or more over the 20 months. And what we find is a lot of people, they actually develop that habit where they start to think, oh, well, that 325, I factored that in. I can just go ahead and keep doing it.
That's right. And so once the loan's paid down, anything further that you contribute past the loan just gets attached to the investment to grow it.
So with our ones, the investment portfolios, it means that everything's already done for you. It's just a matter of choosing what suits your goals, time frame, and also what suits your risk tolerance. And there's a statement of advice tool on the website that can walk you through it. There's different calculators as well. But it's a very easy application. And we do have the informal trust structure where you can simply go ahead and choose, I want to invest as an adult for a child, or I want to invest as a joint adult. So maybe 2 parents or 2 grandparents, and they want to set it up for their child. I'll quickly run through. So we're getting close to the end of this. This is the fund later, just in a bit more of a visual idea. But you can also have a look at this after the webinar too. So I guess what we always say at InvestSmart is, there's always a plan that you need to do. You need to pick the purpose first. Is it a first car? Is it university, getting ready for school? Is it getting a house when the child's a certain age? Pick the portfolio and then put it on autopilot so you can have it, add to it, and set up that, that strength of automation and compounding growth.
So another thing that is making me want to do this, Tom, is because it does make you feel like you've got a little bit of control. And as a parent of a young kid, you don't have a lot of control, right? In your day-to-day life, control is not something that you kind of experience very much, right? So if we put this into place and we do the autopilot set and forget thing, we are controlling Rosie's entrance into adulthood by giving her a little bit of money. And I think that's very, very powerful.
I think also it'll make you look back having done it, and she'll probably be happy as an adult saying, thanks for not buying me that bike.
Yeah, I hope so. That's right. In the words of Chili from Bluey, boring things are important too.
That's right. Yep. Thank you for the context and for the parents that understand what that means. But I mean, I don't know who Bluey is, but just to recap, it's very obviously important. You may not be able to, but starting early is obviously a good thing. Ignore the noise. There's a lot of noise that happens in markets, and that's a separate webinar that we've done, or I did previously, talking about ignoring the noise, because it's such a long-term thing, isn't it? Who knows what's going to happen in the future? Right. And when we go back and look at all the events that have led us to this point, we've had these similar things before. We've had COVID, and markets long-term tend to do well. Automate your way to peace of mind. It sounds like instructions, but you can download the ebook and read about a lot of the stuff that we've talked about in detail. Go to investsmart.com.au/guides. If you've got any questions now, it's one of the best, it's the place to ask, isn't it? So definitely go ahead and ask us any questions that you like. We'll do our best to try and cover them. Normally, we get asked about the tax file numbers, which we covered off. You can get tax file numbers for your child, but remember there's that penalty interest. So if you don't put one in, you might have the tax withheld. So it's very important to suss that out and get a plan sorted in that respect. And did you have any little questions that are still lingering in your mind now, Phoebe?
I was just thinking, well, so one question that we do get a lot is the kid does need to have their own bank account. So that is something that you need to set up. But I think that's a fairly simple thing to do with your bank. The bank account, if you do choose for the investment to be in trust for the kid, in your name, in trust for the kid, then you do need to have that bank account listed. But I think you've covered heaps there, Tom.
We have. I guess that's one important thing that I did mention before about how if you do the in trust for using the informal trust, there might be a way that you can still, when they reach 18, 19, 20, and you want to give them the investment, there is a way or a possibility of doing that without triggering a capital gains tax event. And what the ATO says and what a lot of the information that's there is that if you're gifting and you document this, you document that you're gifting and you're documenting that you're gifting the contributions that you make. And then when they reach that age, you've transferred it to them. That would help to avoid that capital gains tax. That being said, it's a caveat there. You should definitely speak to someone who knows tax law inside and out and can pretty much give you personal advice in the sense of you shouldn't do this or you should do this because your situation. But it's something that you should investigate and just have a look at. We do offer those informal trust accounts on our website.
We do.
Oh, great. I've got a question from Steele. Thank you so much for asking a question. When investing in ETFs, do you get paid dividends? Is this then considered the taxable income? What about about capital growth? Does that get considered as taxable income every financial year? Fantastic question. Did you want to answer it, Phoebe, or would you like me to give it a go?
I'll let you take that one, Tom.
Okay. So it's a question we get asked quite a lot about from our clients when they even see our investment products like our ETF portfolios. And when we get income from a dividend, we actually call it distribution. Distributions inside them have dividends, interest, but they also have sometimes capital gain events. So let's just say, for an example, the ASX 200, which has got the top 200 Aussie shares, there's stocks that come and go. They drop in and they drop out. So one of them a while ago was Sydney Airports that got privatized, or actually, bought, taken off the ASX. And it meant that left the ASX 200, the ETF. So it was holding it and they would have sold it at a profit. So it meant that it registered a capital gain inside there. The company that manages that for you, say BlackRock or even InvestSmart, they would give you the tax statement and they would say, okay, so over the year, you've earned X amount in dividends, you've earned X amount in interest because some of it's sat at the bank, but there's also this sale of Sydney Airport, and that's a capital gain you need to put onto your tax statement. That being said, there might have been something else that was taken out as well as a loss, but that's the ETF manager's job and also InvestSmart's job, should you choose to do a ETF portfolio, our job to give you that tax statement. So you do get paid dividends. Dividends are considered as income. So regardless if you decide to reinvest them back into that ETF, the ATO will say you received income and you'll have to declare it on your tax statement yourself. The capital growth though, think of it, the best analogy is a house. Say you invest into an investment property and you've got tenants that pay rent, that's going to be income. But let's say the house goes from being $500,000 to $1 million. The tax office doesn't say that you've made that $500,000 gain until you sell it. So you'll find that the value of the holdings, like the ETFs, the shares and so on, they'll fluctuate over time. They'll go up and down. That's not considered to be actual income. It's just the valuation, and it only happens when you sell it or part of it's sold.
Crystallize it.
Crystallize it, that's right. Give it to the kid. Yeah, when you transfer it across, that's counted as a capital tax event where you have to actually value it at the market value. It's a very good question because a lot of people don't realize that. Even when they look at the returns, they might go to a company where it doesn't show them. I'll show you an example of what we do, just so as we try to be clear as anything. What we do is, I'll just take this off. We show on our front page and inside, and you should always read the product disclosure statements for any different investment you're looking at. But you can see here we've got the conservative, and we've got the balanced, and we've got the high growth. So sticking with high growth, we can see here that it says 8.3% performance. Now there's an asterisk and it says that's the return, total return per year, per annum since it first started back in 2014. And that includes the admin fees. So it's taken out so you can make an idea. It's got 3.5% there, which is estimated income per annum. So what it's saying is that based on past events, we anticipate that this portfolio that's got ETFs inside it is going to pay about 3.5% in income each year going forward. If I click on learn more, and if I go down to that chart and actually click table instead, we split the capital return and the income, and that 8.3% per annum on average I was quoting, you can see it on the far right. That's actually the since it started or since inception. So they're saying the total return's 8.34, but of that, 5.5% is from capital growth, capital return, as in the investments going up in value, and it's given 2.8% income paid out, so dividends, interest, which is what you'd expect for high growth because it's mostly getting put inside Australian equities, which are shares, obviously, and international equities, which are shares as well. And they are very growth focused. There are some that pay dividends, but this also only has a very small amount, about 5% to fixed interest, like bonds, government bonds, and then cash, which obviously pays interest. So I hope that helps to answer that. Did I miss anything there, Phoebe?
I don't think so, Tom. You are an absolute font of knowledge.
Well, I run the boot camp at Investmart, which is the educational course, and it's something that we spend a lot of time just trying to help people in terms of, this is a follow-up question too, which is great. That makes sense. With the high growth stats, we would use that 3.5% to give us a rough idea of how much taxable income for that year. That's the income from that ETF portfolio. So you could get a rough idea based on that. You could roughly say that it's going to pay around about 3.5%, fingers crossed, going forward over a longer term. So you could use that.
Past performance not being an indicator of future performance, of course.
That's right, yeah. So we can't always look back and say it'll definitely do this going forward forever. That would be great if it did. But what we do is we obviously try and show the data of how it has performed, what the averages are, and try and give you that information going forward. I guess the thing about the InvestSmart diversified portfolios is that we don't just obviously have one ETF. Like any one of us can go out and buy the ASX 200 ETF. We can do that through a broker, no worries.
Absolutely.
But what about our international growth? Like that's taken off, say, in the US, and it's taken off in Europe, all these things. If we were just to ignore that and keep in our own backyard, we're missing out on so much growth. But what happens when stock markets don't do well and the bonds, the cash, the other assets, they're doing well? That's the whole point about diversification. And that's why we
handing that over is a really powerful thing. It's wonderful.
Absolutely. So just to wind up, and thank you so much for the questions, Steele. I really appreciate that. It doesn't mean that no one can't ask us questions going forward. I'll make the slides available at investsmart.com.au/events, and you can download them, go back through them. But there's helpful tools. There's the bootcamp course that we run that you'll see on the website at the very top. You can use that ETF compare tool, and there's also the help center tool. But you can also contact us. You can call us 1300-880-160, particularly if you're looking at our products and you say, well, can I use this to invest for my child? What should I choose? What's the taxable? What's the income? You can also email invest@investsmart.com.au. The other thing too is there's a get a callback feature there too. So if you're someone who actually wants to chat to one of our staff, I think you'll speak to Mitch. You can actually scan that QR code and choose a time, and Mitch will give you a call and basically run through whatever questions you've got about our products. It's a very handy 20-minute call. You can go ahead and do it. There's no charges with that. And thanks so much, Mike, for saying that comment there. Phoebe and I definitely appreciate it. We appreciate everyone who comes along, because these are things that definitely, help your future grow, help your children's future grow. And that's what we do at InvestSmart. So thank you very much.
Right. Thanks, Tom. Thanks everyone for coming. Thanks for having me.
I'm sure there'll be more coming up, but if you've got questions, if you've got even any kind of advice in terms of, I'd love you guys to talk about X topic, just send an email, invest@investsmart.com.au. See you later.
See ya. Bye.